Okay, so you want to own a Supreme. The little red box logo, a line wrapping around the block every Thursday morning for a drop that sells out in minutes. A brick that resold for over $200,000 because it had the logo stamped on it. You picture opening a store, riding that scarcity, watching people pay triple retail for a t-shirt. That's the picture. Here's what the line outside the store doesn't show you. There is no Supreme franchise. There is no Supreme license you can buy into. There is no Supreme store you personally could ever open, because after 3 decades in business, the entire company operates only around 17 stores on the planet, every single one owned and run directly by whoever currently holds the brand, never handed to an outside operator. And the 2 companies that have owned it in the last decade, a private equity firm and then a multi-billion-dollar apparel conglomerate, both eventually walked away, one of them writing off hundreds of millions of dollars in the process. So the real question isn't, how much does it cost to open a Supreme store? It's, why does a brand this famous refuse to let anyone else run it? And what happened to the last company that paid billions to control it anyway? Here's the part that breaks the mental model immediately. Supreme was founded in 1994 as a single skate shop in downtown Manhattan, and it built its entire business model around the opposite of what most retailers chase. Most brands want more doors, more distribution, more square footage. Supreme deliberately kept the opposite, releasing small weekly drops of strictly limited quantity, refusing wide wholesale distribution, and operating only a tiny handful of its own directly run stores across the United States, Europe, and Asia, 17 locations total even at its peak size under corporate ownership. There was never a franchise agreement to sign, never a licensed retail partner model like New Balance or Vans, because the entire value of the brand was built on artificial scarcity, and handing control to outside operators would have been the fastest way to destroy it. That scarcity made the company itself extremely attractive to buy into, just not at the store level. In 2017, founder James Jebbia sold a 50% stake in the company to the private equity firm the Carlyle Group for $500 million. Then in 2020, VF Corporation, the same conglomerate that owns the North Face, Timberland, and Vans, bought Supreme outright for $2.1 billion, describing a business generating roughly $500 million in annual revenue with gross margins above 60%. So when people say they want to own a Supreme, the only version of that which has ever actually existed is buying the entire company or a controlling stake in it, a deal available only to private equity firms and public conglomerates with billions of dollars to spend, never to an individual operator opening a single store. Since there was never a franchise tier to buy into, the only real entry point into Supreme ownership was buying the whole business, and the price of that entry tells you everything about how the market valued the scarcity model. VF Corporation paid $2.1 billion in 2020 for a company generating around $500 million in revenue, a purchase price running roughly 4 times annual sales. A premium justified at the time by Supreme's gross margins above 60% and by the assumption that the brand could keep growing while staying scarce. That assumption turned out to be the entire problem. VF Corporation's own plan projected Supreme's sales growing 8 to 10% a year over 5 years through expanded direct-to-consumer sales and gradual geographic expansion, adding new doors in Asia, pushing into new product categories including footwear. But every one of those growth levers directly worked against the thing that made Supreme valuable in the first place. More doors meant less scarcity. Wider product categories meant a less curated drop. Deeper geographic expansion meant the brand showing up in more places, more often, exactly the opposite of the model that built the resale premium in the first place. VF Corporation was paying a scarcity premium while simultaneously being expected to grow the business by making it less scarce, and the market noticed almost immediately. There was no franchise fee, no build-out cost, no opening inventory minimum in the traditional sense, because there was no smaller entry tier available. The entry cost of owning Supreme was, functionally, $2.1 billion, all at once, with no smaller version of that bet available to anyone without a conglomerate's balance sheet behind them. Here's where the dream met the invoice, at the corporate level instead of the storefront level. Supreme's gross margins above 60% looked extraordinary on paper. A company selling a t-shirt with a red box logo on it for far more than a t-shirt should cost to make, capturing almost the entire markup instead of losing it to a chain of licensees and retail partners the way Vans or Reebok does. For a brief period, That margin structure made Supreme look like one of the most efficient apparel businesses VF Corporation had ever acquired. But the accounting turned quickly once growth stalled. In VF's fiscal year 2023, Supreme's revenue fell 7% year-over-year to $523 million, and VF was forced to record a cumulative impairment charge of $735 million against the brand across that fiscal year alone, essentially admitting the $2.1 billion price tag no longer reflected what the business was actually worth. More impairment charges followed in the year after that. On the resale side, the market told the same story. Supreme had once been the single largest apparel brand on the resale platform StockX, but by 2022 it had lost that top spot for the first time in the platform's history, and its share of StockX's apparel category fell from roughly 36% in 2020 down to 16% by 2024, while public search interest in the brand dropped nearly 30% over roughly the same two-year window. The margin didn't disappear because of markdowns, royalties, or licensing fees the way it does for other brands in this series. It disappeared because the entire premium was built on desire outpacing supply, and once growth targets forced supply to catch up even slightly, the premium that justified the purchase price started evaporating with it. Here's the structural tension that defines Supreme more than any other brand in this series. What a corporate owner needs is growth, expanding revenue every year to justify the acquisition price and satisfy shareholders. What Supreme's actual business model needs is the opposite: restraint, deliberately capping supply below demand, keeping the drop small enough that people still line up around the block wondering if they'll get one. As one industry analysis of the brand's decline put it plainly, scarcity and growth are fundamentally oppositional forces, and a business built entirely on the first one cannot indefinitely chase the second without eroding exactly what made it valuable. This isn't hypothetical, it already played out in full. VF Corporation spent 4 years trying to grow a scarcity brand, and in July of 2024 announced it was selling Supreme to EssilorLuxottica, the eyewear conglomerate behind Ray-Ban and Oakley, for $1.5 billion, a deal that closed in October of that year. That's $600 million less than VF paid just 4 years earlier, on top of the hundreds of millions of dollars in impairment charges already absorbed along the way, and VF disclosed the sale would actually reduce its earnings once finalized. The brand hadn't disappeared, and its stores, still fewer than 20 worldwide, kept operating largely as they always had. What had disappeared was the theory that scarcity could be systematically scaled by a public company answering to quarterly earnings. So what would you actually be buying if you tried to own a piece of Supreme today? Not a franchise, that tier has never existed. Not a licensed store. The brand has always refused that model specifically to protect its scarcity. What you'd be buying is a stake in a business whose entire value depends on staying small enough to feel exclusive, a proposition that has already broken two sophisticated, well-capitalized owners who each believed they could grow it without losing what made it worth owning in the first place. The hype is real. People still line up. But the economics underneath that line are a scarcity model that has proven, twice now, structurally incompatible with the growth a corporate owner is required to deliver.